War is here, and the price of oil is on the rise. Crude oil futures are already up over 8%, and that's nearly a 15% increase over the past 5 days. The major market indexes are looking to open down with the fear of a broader war escalating, and whenever there's global conflicts like this, you will typically see the price of oil rise, especially if large oil producers are involved. As we all know, the Middle East is a critical region for global oil supply, and if this conflict continues and gets worse, then it could lead to supply shortages. And at its core, the oil market is based on supply and demand. We've seen this before in history, and if we go back just to Russia invading Ukraine, we saw the price of oil go up nearly 50% there. However, Russia was directly involved, which is a major oil producer, and the US and much of the Western world put sanctions on Russian oil. So things would have to really spiral if we get back to these elevated levels. But if that does happen, oil and gas stocks will be raking in profits. As an example, ExxonMobil hit an all-time high of $4.45 in quarterly earnings per share. That was $19.5 billion of free cash flow in 1 quarter. And that is one of the nice things about having oil and gas stocks in your portfolio is they kind of act as a hedge where during these times of global conflicts and high energy prices, the companies actually make more money. So today I'm going to share my top 5 oil stocks that you should be targeting or at least have on your watch list, especially if the market sells off like it seems to be. And by the way, this list will include oil producers who would benefit from higher oil prices and midstream pipeline companies that benefit no matter what the price of oil is as long as volumes remain high. And I particularly like those plays since I think longer term, the US strategic policy seems to be increasing volumes and providing more energy, but this oil price shock, especially if it gets worse, could get pretty interesting. With that said, let's jump into the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'm going to be using the stock screener and stock analysis tool over on dividenddata.com. This is the research tool I personally developed to help me find better dividend stocks. And over the years, it's helped me add to my portfolio some oil and gas giants like ExxonMobil. I've gotten a great return on that one so far, 230%, and newer pipeline additions to my account like MPLX and HESM. I also have this stock screener in the AI Analyst that helped me find even more high-quality energy stocks. And by the way, you can add additional features. As an example, you can look for dividend growth with a 5-year compound annual growth rate. Let's say you want that over 5%. Click Regenerate. And then boom, you can look at some of the higher dividend growth oil and gas stocks. And spoiler, some of these will be on the list. So before I get into stock number 1, if you want to use this tool, it's all available at dividenddata.com. Right now is the best time to join. We have our summer sale where you can get 50% off annual membership. The link is in the description and pinned comment of the video, and you can lock in that discount price for life. This is the best price we ever offer. There's a 30-day money-back guarantee, so no risk in trying it out. Let's get into the stock analysis. So the first company I'd be targeting if oil and gas prices go up, especially over a prolonged period, that would be Texas Pacific Land Corporation, ticker symbol TPL. And the reason I'm starting with this is it's a company a lot of people do not know, and I wish I had it on my radar earlier. It is unique in that it's not an oil and gas producer. It's not a midstream energy company. This company just owns a ton of land in Texas around the Permian Basin, and then they get paid royalties for the oil and gas produced on their land. So obviously those royalty amounts would be impacted by the price of oil. This stock is also down quite a bit from its all-time high, and I've actually been buying a few shares around this price, but that's just to start my position. Longer term, this is a top stock I'm actually targeting in an oil crash, when in my opinion, these would be at a deep discount. It's not at a super discount right now, but if the profitability goes up, it could be a good trade and a decent entry point. If we look at the margins for TPL, you can see that this is an incredibly high margin business. They have 89.9% gross margins, 76% operating margins, and 64% net margins. This company basically just prints money. And they've actually been around since 1988, and they only have 111 employees. But for nearly a century, they barely did anything. They just collected royalties. Over the past decade, they've actually been hiring and building out a business where they view it as their goal to recruit people to then drill on their land. And they've started building up a little bit of infrastructure to make it super easy for these companies to come in. It's really interesting. I'll probably do a full stock review on this company soon. But as you can see, since they started getting more and more people drilling on their land, their earnings per share have just exploded. And despite the price of oil going down over the past few years, they are nearly making more in earnings per share compared to those 2022 peaks. And that's because this is a growing business and it's going to keep expanding. So the next time there's some huge oil price surge, this company is going to rake it in. They have a great balance sheet with $1.2 billion in shareholder equity. They have $460 million in cash and cash equivalents, negative $460 million in net debt. So the financial health is very good for this business. And yes, the dividend yield is low, but this is a dividend growth stock. They've started paying a base quarterly dividend that they increase on an annual basis. But on top of that, they do these very large special dividends when they build up a big cash cushion. As an example, in July 2024, they did a $10 per share dividend. That was on top of their quarterly dividend. And earlier this year, they increased their base quarterly dividend by 36.75%. They are also buying back stock, so they're reducing their shares outstanding. So I really like this business, and I'm always looking for an opportunity to pick up some shares. And on a multi-decade time horizon, I'm likely trying to make this a core position, and I am dreaming for another oil crash like 2020. And the reason why I say that is the 5-year total return for TPL stock is 466%. So in hindsight, obviously this was a no-brainer. I didn't even know this company existed back in 2020. But with stock number 2, I'll talk about a company I did know existed, and I bought a lot back then. And that's ExxonMobil, ticker symbol XOM. I have a great cost basis on this stock. I have a 232% total return. The stock pays me $676 in annual dividend income, and that's a 9.68% yield on cost, but I've reinvested dividends all those years, earning me 32.8 more shares in the stock, which boosts my dividend yield on an initial cost basis to 11.98%. So this is one that I don't plan on selling forever, but I likely won't be adding at these prices, but it's an extremely high quality oil and gas stock. As you can tell, this is an oil producer, so their earnings are heavily impacted by the price of oil. And that's why you see a lot of cyclicality in their earnings. So ExxonMobil will do very well with higher oil prices. But there's quite a few things I like about ExxonMobil. For one, they have a great balance sheet, $262 billion in shareholder equity, $17 billion in cash and cash equivalents. Their net debt's in a much healthier position of $20 billion. That got as high as $61 billion in 2020. But when they were raking in all that cash, they paid off a bunch of the debt. And this company has the capacity to just rake in free cash flow during the boom times. But as a dividend-focused investor, the main thing I love about them is that they continue to pay and grow their dividend over time, even during down cycles. And they leverage that balance sheet to continue paying their dividends and actually investing in the future of the business. The 10-year CAGR of the dividend is 3%, current dividend yield is 3.61%. The payout ratio is very healthy at these levels. And ExxonMobil recently made the acquisition of Pioneer Resources, and they've been investing in their own infrastructure. So the next time they do have some big oil price surge, they'll be making even more in the future. So with these oil and gas giants, their earnings are volatile, but they should have a long-term trend of growth. Stock number 3 I'm going to share today is MPLX LP. This is a limited partnership. It's a midstream oil and gas stock, and this is a company with high yield and high dividend growth. Similar to TPL, I wish I had this on my radar back in the day, but I did recently just make it a position in my dividend growth stock portfolio. And if the market sells off on Friday, I'll probably be adding to this. I did a full stock review video on MPLX just last week, so definitely go and watch that. It's nearly 25 minutes long, and I do a deep dive on the company. But I'll give you a brief overview here. As you can see, based on today's price, it's a 7.38% dividend yield, and they've had growing earnings per share in recent years, and there are expectations of mid to high single-digit earnings per share growth every single year. This is a dividend growth stock with a 10-year compound annual growth rate of the dividend at 8.84%, and the 3-year CAGR is 10.7%. Their most recent dividend increase was 12.5%. And to be honest, it's kind of crazy to even think that you have a 7% yielding stock with a 12% dividend increase. The payout ratio is very sustainable based on free cash flow. We're in about a 70% range. And the company has not diluted shareholders in a number of years. And they do occasionally repurchase shares, or in this case, units every once in a while. As I mentioned, this is a midstream oil and gas stock, so they're focused on the transportation of the commodities. And again, go watch my stock review for a full analysis. But what I like is they have a big presence in both crude oil and in natural gas. And natural gas is more of the growth business of the two, and they are investing and making acquisitions in increasing their natural gas presence. So they have a bunch of pipelines for transferring natural gas liquids. And with these kind of stocks, I love to visualize their assets over a map. It kind of helps click in your brain to see what kind of things they own. And if you didn't know, Marathon Petroleum owns around 60% of MPLX. And this is a partnership that kind of formed out of them. And a lot of their assets have origins all the way back to Standard Oil. So this is a huge company in the Midwest and in Texas. And we got pipelines, we got marine facilities, and this is going to different refineries. This is a huge business. A lot of the contracts for MPLX are based on volume, and these are long-term fee-based contracts, so the downside exposure to lower commodity prices are minimal, and really the only risk is if volume somehow collapsed. However, previously to this conflict and the surge in oil, I was personally more worried about lower oil and gas prices, so I was targeting these midstream stocks, and I still think that's probably the long-term play right now. As I mentioned, 2020 was an awesome opportunity to buy this. You could have gotten the stock from a 15% dividend yield even up to a 25 and briefly a 30% dividend yield if you were paying attention. And I wasn't. I didn't know this company existed. The 5-year total return on MPLX stock is 348%. And it even has a 36% total return over the past year when oil and gas prices were actually going down. In a similar vein, for stock number 4, I have another midstream oil and gas stock. That's HESM, Hess Midstream Limited Partnership. Again, this is another new stock for my dividend growth stock portfolio. Both of these I'm looking to build up over time. And this stock is even more shielded to lower commodity prices than MPLX. They have 100% fee-based contracts that go through 2033 with built-in inflation escalators. I'm planning to do a full stock review video on Hess Midstream soon in the future. The only downside would be somehow there's lower volumes, but they even have guarantees to be paid fees up to 80% volume. And as you can see, during 2020, they still remained very profitable, and they even grew their dividend payment during that year. The current dividend yield for HESM is 7.2%, and this stock increases their distribution every single payment. The 5-year compound annual growth rate of the dividend is 10.49%. The 3-year CAGR is 8.93%. And as you can see here, they have an increase every single dividend. The most recent one was 1.23%. And based on free cash flow, the payment's very sustainable. But HESM and MPLX are limited partnerships, so they actually base it off of distributable cash flow. It's a little different. I explain it in my MPLX video. And I'll probably talk about it again when I do an HESM full stock review. Now, the one thing I'm concerned about with this stock is the dilution. They continually issue more and more shares to fund projects. And frankly, I just wish they would stop. And I'm trying to do more and more research to understand why this keeps happening. This screws up a lot of their metrics when you look at it on a per share basis. It looks like they're declining. But if you take a look at their income statement and cash flow statement, it's anything but. This company's growing a lot. Since 2020, they've gone from $1 billion in annual revenue to $1.5 billion. And their free cash flow is $634 million in the latest year, far exceeding their $235 million in distributions. Similar to MPLX, this stock was a steal in 2020. You could have gotten it over 15% dividend yield. And the 5-year total return is 206%. For stock number 5, I have another company I just learned about recently when I did a video covering the latest dividend increases. That's EOG Resources, ticker symbol EOG. And as you can see here, they have a 5-year dividend compound annual growth rate of 24.96%. And this company got on my radar by having another 4.6% dividend increase. And I was looking into their financials and I was kind of impressed. This is still a newer business to me, but they are an oil and gas producer, and I do really like their financials. Particularly, I like that their earnings per share drop-off has not been as much as Exxon and Chevron. So there seems to be a lot more structural growth happening as this is a smaller business compared to them. The current dividend yield's 3.38%, and this is a big-time dividend growth stock. The 10-year compound annual growth rate is 16.8%. The 3-year CAGR is 10.7%. And as you can see, they had a flurry of special dividends during that last oil boom. I mean, you can go and count them. Was that 1, 2, 3, 4, 5, 6, 7? 7 special dividends. This was on top of their base quarterly dividend, which they increase regularly. This is also very sustainable with a 30% free cash flow payout ratio based on fiscal 2024 and 32% based on net income. They've even started repurchasing shares in recent years. And this one is not a limited partnership. It's just a regular dividend stock, so you can get the qualified dividend rate and no K1 documents like you have to have with the partnerships. A member in our Discord community mentioned that this stock has way higher returns on capital. The return on capital employed is around 20% to 40%, and return on invested capital around 15 to 30%. This one does seem to be more of a growth stock compared to a lot of the oil majors. The 5-year compound annual growth rate of revenue is 7%. Net income per share is growing at a 7% 10-year CAGR. Free cash flow per share is growing at a 32% 10-year CAGR and a 12% 3-year CAGR. And fiscal 2024, they actually had their highest free cash flow ever. So the financial health of this business looks to be very strong, even with lower commodity prices. They have growing shareholder equity. Their balance sheet looks nice. They have $6.5 billion in cash and cash equivalents, and they have negative $1.5 billion in net debt. So EOG Resources, I was very impressed when I looked at this, and frankly, I added it to my watch list, and I might do a full stock review video in the future. This company has also done really well since 2020 with a 194% total return. However, unlike those pipelines, the total return has not been good over the past 3 years, 4.7% total return, and 5.1% over the past year. And that's the thing with oil and gas producers. Yes, they make a lot of money when the price of oil is high, but the stock price also tends to go up during those periods. So I like to buy these companies when they're deeply out of favor. As an example, when there's an oil crash, when they're unprofitable, that's the time to buy. And to wrap up this video, I'm going to throw in a little bit of a bonus stock. It's kind of an energy company, but not really. And that's Berkshire Hathaway, ticker symbol BRKA. That's their very expensive share, or BRKB, where you can get it at a much more reasonable price. This is Warren Buffett's famous business, and in my opinion, the best economic engine ever built. And they do own quite a few oil stocks. They also own a lot of energy infrastructure, both in utilities and in pipelines. They have a big natural gas operation, and Berkshire Hathaway Energy is one of their largest businesses. They have a killer balance sheet, and they're sitting on a mountain of cash. I'm talking $347 billion in cash and short-term investments. They have $305.5 billion in treasury bills, just getting them yield. So Berkshire Hathaway is a business that you can invest and hold on to forever, pretty much. So that's my bonus stock, and let's wrap up this video. If you want to use my stock research tool I showed throughout, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. And right now is the best time to join. We have our summer sale active where you can get 50% off for life. That's right, you can lock in that discount price forever. And this is the best deal we ever offer. You can get a 30-day money-back guarantee, no risk. And if the tool helps you find just one better stock, then it way more than pays for itself. The link is in the description and pinned comment. And with that said, thanks for watching, and I'll see you in the next video.